Hi there, I'm Jason Gold, and I am back with another episode of Investor Insights. This is where I give straight talk on all things investor relations. Today we're talking about stocks, and this crazy notion that I have that stocks have emotions. What they tell you in business school about valuation, I think, is only part of the story. Those professors will tell you that it's all about having a formula, a discounted cash flow formula. I'm here to tell you that stocks have emotions. What? Yeah, stocks have emotions. And that's because the people who buy and sell stocks are human beings. They run the gamut from being greedy to scared, and they move in between those emotions very quickly. That's what dictates their buying and selling behavior. Think about it this way. Being an investor is a great job. Sometimes they fly first class. Sometimes they fly private. They're always staying in beautiful hotels all around the world, getting taken out to fancy dinners, and talking about very cerebral things. They think they're really smart and it feels really good. So people like that job and they don't want to lose it. The biggest fear most investors have is losing their job. And one quick way to lose their job is to own stocks that blow up. What does it mean to blow up? It means a stock that tanks really, really quickly. That is the number one way to lose your job. And so you think about it. Guys love their jobs. They have all these great perks, and they're running around scared. They don't want to own blowups. And so you have to think about it this way. Investors are going to shy away from any company that could give them a blowup. I own a blowup. I lose my job. I don't want to touch any company that's going to blow up. I'm going to run as far as I can from those companies and gravitate towards the companies that give me assurance that they're not going to blow up. How does that really happen? Now, no one can ever be totally sure, but the companies that are consistently setting guidance that they can outperform are companies that investors want to gravitate towards. So think about two companies at two ends of the continuum. One company sets the guidance what they think they can do, and sometimes beats it, sometimes misses it by a little bit, because that's just how the nature of the business moves around. That's not a company people want to own, because that's the kind of company that can blow up. On the other hand, think about a company that consistently under-promises to the street and regularly over-delivers or outperforms on that guidance. That's the kind of company people gravitate towards, and that's the kind of company that they pay the big multiples for. I think the other thing you need to always think about is that there's just bumps in the road as you normally manage a business. And if you give guidance that's too close to what you actually think you're going to do, you don't give yourself a lot of room to hit bumps in the road. I had a client who their FP&A team would develop a model with a low, medium, and high scenario. And they always gave guidance somewhere between the medium and the high scenario because they wanted to project how well things were doing. Well, this company regularly came in at the middle to low end of that when the business moved around just in the normal course of business. And as a result, they frequently missed their guidance and the stock's multiples suffered. There's just no reason to do that. The minute that I got there, I started to guide them to give the street the guidance that was set at the low end of their models. That way, any scenario other than the absolute worst that their FP&A team thought they could do meant that they were beating the street guidance. That's what helped get the stock's multiple to go up a lot. So what does this really mean for companies? What should a company do to gather the emotions, the positive emotions from investors to get them into their stock? Number one, set conservative guidance. Number two, become known as a company that regularly sets conservative guidance. It's totally okay to be known as a company that does that. You don't want to be known as a company that sandbags the guidance. Don't blow the numbers out of the water because then people don't think you have a good handle on what the business is actually going to do. But give yourself a nice margin of error. It will also allow you to project an air of confidence as you go through the quarter. The worst thing you could do is give guidance and immediately wonder, are we even on track for that, or is there a little bit of risk? Investors will sniff that out during the course of the quarter, and you just don't want that. Number three, consistently beat and raise the guidance that you give. The consistency part of this is critical because if I, as an investor, see that you are consistently doing what you said and consistently beating and raising your numbers, I will feel safe with you and I will reward you with a better multiple. That's because I won't be fearful that you're going to blow up. Again, we come back to that continuum of fear to greed. You want people as far this way, or rather, the people that get further this way on the continuum reward you with a better multiple, and that's how you get the value that you really deserve. And the last thing is become known as a company that consistently underpromises and overdelivers. The street really likes a team that does that. And sometimes there can be good chemistry between the CEO that's frequently, but not always, frequently quite bullish, and the CFO that says, I hear that optimism, but I'm going to temper it in the guidance. My favorite phrase that I advise people to use is, we take our commitments to the street very seriously when setting our guidance. That to me is really the sign of a mature company that understands the game that Wall Street plays here with the whole beat and raise cadence. So that's it. As always, thanks for tuning in, and I look forward to seeing you here next time on another episode of Investor Insights.